So for chapter one, it's the chapter that's not going to be tested so much in your midterm or your final exam. Chapter one is just for context. It tells you what we're going to be working on for the rest of the next couple of weeks. Okay. So, how would you describe accounting? So, if you don't mind, can you scan this barcode or copy this link and see if you can answer this question? How would you describe accounting in a few words? So
Mhm.
I see painful, organized, debit and credit. It's your lucky day. In this course, we're not going to be talking about debits and credits. All right. So that's usually the concept that really confuses people. So we're not going to be talking about debits and credits in this course. Okay. We're going to find a way around that.
Yeah, because in high school we have that like
Yeah.
debit and credit, debit what comes in, credit what goes out.
Yep. Yep.
Yep.
Managing money, reviewing financial information, measuring and processing of financial and non-financial information about economic entities such as corporations. It's boring. Summarizing, recording, analyzing, it's scary. The process of recording financial transactions, mysterious, interesting. Assets, liabilities, owners, equity, and accounts. Very good. While we're going through these, I'm seeing a lot of accounting terms: assets, liabilities, equity. Is everyone familiar with these terms? Have you heard them before?
Yes.
Okay, that's good. Somebody says, I don't know. You know what? I appreciate the honesty. Managing money. All right. Accounting is used to record transactions made by an entity. This is done to let investors, creditors decide what to do next. So some people have a very good understanding of what accounting is all about. And some people, as they said, I don't know anything at all. And that's okay, right? It's the beginning of the course. And so hopefully by the end of the course, most, if not all of us, will have a better understanding of accounting. Okay, so as I said before, this chapter is not going to be tested. It's just for context, okay? Just for us to get an idea of where we are and where we are going. So I'm gonna start off by listening to this quick YouTube video.
In this video, I'll give you an introduction to accounting by telling you a story. It's a story about Claudio and how he runs his business in Italy. Before we start, let's just get clear on what accounting is. Accounting makes it possible to systematically record, analyze, and report important financial information and communicate the financial health of a business to all interested parties. It's called the language of business, and it's the backbone of any company because every business needs reliable data to make informed decisions. But what does that really mean? Let's just take a moment to make this a bit more transparent and understand the basics of accounting. So let me tell you about Claudio. Imagine we're in Italy, which is also one of my favorite places, a nice beach city where a man called Claudio is selling souvenirs to tourists. He only sells one item, a beautiful plate made from colorful glass. In the morning, he leaves his home with 100 euros and goes to the manufacturer of the souvenir. Each plate costs 1 euro, so Claudio buys 100 pieces with his 100 euros. He walks to the beach and sells the plates to tourists for 5 euros a piece, and by noon, he's sold out. He goes home happily and repeats the same process the next day. After a month, he wants to know how much the business made. What if he sold more than one item? Which one was more profitable? Would it make sense to expand his business, like rent a fixed stand at the beach? Without a way of recording the daily activities of his business, he's not going to be able to answer these questions. Accounting makes this possible. Not only will each financial transaction be recorded, but Claudio will also get detailed reports summarizing his financial performance. We call these reports financial statements.
Okay, so in that video, why did Fazio, why did he need an accounting? What was his need for accounting? What did accounting do for him?
To calculate his profit.
Calculate his profit, see how his business was doing, give him a detailed report, right? I'm reading also from the messages chat group here. So yeah, he needed to know how his business was doing. He needed to have a visual to really see and analyze how he's doing so that he can use those numbers in order to make decisions. Okay, so we need that information, that financial information in the form of financial reports to not just get a snapshot of how our business is doing, but we also will need to be able to make future decisions, informed decisions for our business. Someone raised their hand, go ahead.
Yeah, so like to make the balance sheet that is a like profit and loss statement.
Yeah, that's right. So we're able to get a look at the accounting equation. That means if we look at our assets, which we would say are the things that our business owns, right? You own your assets. If we look at our assets, our business owns these things, and we compare it to what our business owes. So that will be the liabilities of the business as well as the equity. So we can say that for liabilities, that is what the business will owe to creditors. So the bank and other people who are lending the business money, but also what we owe to our owners. So we owe the owner something, and that will be called the equity. This course, why are you taking this course? Well, you're taking this course because, not just because you need to pass it in order to do your classes, in order for you to pass or graduate. You're doing this course because even though you're not going to be working in accounting, you're going to be working in some type of organization where you have to make decisions. And most of the times, in order for you to be able to make decisions, you're going to have some type of understanding of the accounting of that organization. So if you're going to be going into marketing, you might need to make some decisions as the marketing manager. For example, you need to be able to understand accounting so you can have some way of justifying your marketing plan. So this is how much I think I need to spend on marketing, and you have to be able to justify that to your manager or to the board of directors why you think we should invest this much in marketing, and showing them exactly how this is going to benefit the organization. And honestly, if you don't have an understanding of accounting, then you wouldn't really have a good points to support your marketing plan. Same for if you decide to be an HR. I know a lot of students in here are trying to go into HR. You're going to need to understand the language of accounting. You're going to need to be able to speak in accounting language, nothing too in depth, but you're also going to be communicating with accountants. You're going to need to be able to understand what they're saying to you when they start talking as well, right? So many different parts of the business, many different people and stakeholders in the business, it's very beneficial for us to be able to understand the language of accounting, because at the end of the day, the bottom line is all about money, right? The bottom line is money. So if our bottom line is money, whenever we are making any justifications as to this is the decision I want to make for this business, you're going to have to tell us, how is that going to support our bottom line? How is that going to support our strategy? Okay, so do we kind of understand now why we're here in this course, even though we're not going to be accountants one day? Okay, good. All right. So for those who still don't understand, hopefully by the end of this course, you'll get it. You'll get why you're here. All right, so forms of business organizations. Really quickly, we know there's one called a sole proprietorship, and this is a form of business that's owned by only one person. It's a small business, right? And there are advantages and disadvantages to setting up these different types of organizations. There's a partnership. So maybe you decide that you want to go into business with someone else or a group of people. And then there are companies, and these are forms of businesses that identify as a separate legal entity or a separate legal identity. And a separate legal entity, does anyone know what that means? It's a pretty common term. Anyone heard of separate legal entity as a benefit to starting a company instead of starting a sole proprietorship or a partnership? Oshini?
Yes, hi, Professor. So what I learned in ADMS, I think 1,000, it said that the benefit of owning a company that is like a separate legal entity or like a corporation is that when you're in a sole proprietorship, if there's like a problem with the company, then like the company and the owner is basically the same, but in a like sole proprietor, in a separate legal entity, the owners and the company are different. So you can sue a company, and then it won't really affect the owners.
Exactly. So somebody can sue the company, and that you're suing the company, but even though I am one of the stakeholders or owners in the company or shareholders, my assets, the things that belong to me, don't have anything to do with that that legal case. Whereas in the sole proprietorship and the partnership, if they sue the business is pretty much me. So whatever they claim, whatever they are able to get from that lawsuit, let's say they get $1 million and my business is only worth $500,000, well, the other $500,000 is, guess where it's going to come from? It's going to come from me, right? So that's one of the benefits of having a company over a sole proprietorship and partnership. And right here on this slide, what I did is I have the advantages and disadvantages. So as we can see, sole proprietorships and partnerships are easy to set up. So most people will just go for that in the beginning. Small businesses, they're just going to do a sole proprietorship, or they're going to team up with a friend or a couple of friends and start a partnership. Another benefit of this is the tax advantages. There are lots of tax credits and tax incentives that applies to people who start these types of organizations. But a disadvantage is that it's very difficult for us to raise funds. As a sole proprietorship and partnership, it's difficult to raise funds. But if we are going to start up a company, one of our benefits is that it's going to be easy for us to raise funds, as well as that personal legal, no personal legal liability, because we are considered to be a separate legal entity from the business. The business is its own entity and I am my own entity. Any questions so far? Did someone ask, what is a tax credit? So a tax credit is something that reduces the taxes that you have to pay. Let's go back to this slide for a second. Some of the roles of accounting. One of the roles of accounting is scorekeeping, all right? Scorekeeping, and scorekeeping is what we're going to be doing for midterm one. So all of the content from today up to midterm one is going to be all about the role of scorekeeping. Just like in a basketball game, when you're trying to figure out what the Raptors got compared to the Lakers, then they'll have a scoreboard and you'll be looking to see who's winning, who has the most points, who has the least points. It's the same with financial accounting. Scorekeeping, in this, accountants use the balance sheet and income statement to report to its shareholders how the company did in the last fiscal year. So how did we do? We can ask existing investors and creditors can ask themselves, should we continue investing or lending, or should we liquidate the business? They can also, the new ones can also say, is this business worth lending to or investing in? So they're going to be looking at the scores to see if we should continue, or if we should, some new investors or creditors might be wondering, should we even start with this business? How are they doing? And then another role is attention directing. So what needs our attention? That's what that role is all about. And this role has to do with management accounting. And this is what you're going to be seeing on your second midterm and your final exam, okay? What needs our attention? So let's just assume that we had a goal. our goal is to increase sales by 10%. Increase sales by 10%. Now, how can we achieve this goal? Well, somebody says, you know what, let's launch a marketing campaign. If we market this product, then sales can go up by 10% probably. Now we go through, we execute the plan, we're measuring the results, we're comparing the results to the goal and the plan. And then we realize that, you know, we actually did not increase sales by 10%. So what needs our attention? So in this role, we're going to be looking at the results to find out what can we do differently next time? How can we reorganize the resources to adjust the plan so that we can close that gap? That gap meaning actual sales and the planned sales, there's a gap. How do we close that gap so we can get closer to our goal of increasing sales by 10%? So attention directing, where do we focus our attention? The next role is decision making. So what are our next steps? So accounting can help us to solve problems and make informed business decisions. All right, so there are a bunch of models that you don't really have to worry about right now that we can use in order to help us make those short-term decisions. Okay. And lastly, a quick look at the difference between managerial accounting and financial accounting. So financial accounting has to do with external reporting, while managerial accounting has to do with internal reporting. And what does that mean? Whenever we produce an income statement, whenever we produce a balance sheet, any of those types of financial statements, we are producing those for people outside of the organization. That will include creditors. Anybody here who wants to buy needs a mortgage. If you need a mortgage, the bank is going to ask you to provide your pay stubs. How much money did you make? How much debt do you have? They're going to ask you all of these questions, ask you for all of this paperwork in order to decide if they're willing to take the risk. Should we lend that mortgage? So it's the same for financial accounting. The financial statements are provided to people outside of the organization so that they can decide whether or not they should lend to the business, should we lend them money? Or whether or not they should invest in the business. Should we invest? Just like right now, a lot of people are looking at investing in stocks in different businesses. And in order for them to make informed decisions about that, they might go online to double check and see what do their financial statements look like. And for managerial accounting, we produce financial statements, financial statements, but this time these statements are for use inside of the business. So for example, we're producing these statements so that managers who are working inside of the business can figure out how can we improve. So they might look at their results in sales and they can see, okay, we didn't do as good as we projected to do. So what can we do differently next time? All right, so financial accounting is providing information for people outside of the business. Managerial accounting provides information for people inside of the business. All right, so these are other differences between them, where the financial accounting is looking at the past information. Managerial accounting is looking at the future. Okay, so we're trying to predict things in managerial accounting. Financial accounting is we're trying to figure out how did we do last year, right? Financial accounting looks at a broader scope, so it kind of looks at the business as a whole, whereas managerial accounting is more narrow. It's looking at probably one department. So let's look at, for example, H&M. H&M has the retail department, they have the warehouse department, they have a bunch of different departments, the factory department, and they might be able to zoom in to how is this part of the business, this specific department doing in terms of profits, comparing costs to the revenues that department is generating. All right, so this is just, you can also look at this video that I have linked here. and it gives you a quick breakdown of the difference between managerial and financial accounting.
Let's do this. I want to kick things off with a couple of definitions. Financial accounting is the process of recording, summarizing, and analyzing an entity's financial transactions and reporting them in financial statements to its existing and potential investors, lenders, and creditors. On the other hand, managerial or management accounting is the process of identifying, measuring, interpreting, and communicating information to management to assist them in planning, decision-making, and risk management. If that doesn't make a whole lot of sense to you, then honestly, I don't blame you. Trying to summarize two broad practices into just a couple of sentences is a difficult task. I think it's easier to build a picture of these two branches of accounting by looking at their similarities and their differences. So how are they similar? Well, like I just mentioned, they're both branches of accounting. Accounting, which has been referred to as the language of business, is a huge field of study that can be divided up into several different practices. Things like financial accounting, managerial accounting, tax accounting, audit, bookkeeping, and forensic accounting are all different branches of the same tree, and financial and management accounting are just two of those branches. They also both involve collecting financial information and presenting it to their target audience in the form of financial reports. But who is the target audience and what financial reports? We'll get into that now as we talk about the 5 differences between financial and managerial accounting. Difference number 1. Who is the target audience? In financial accounting, the target audience is external, and in managerial accounting, it's internal. Let me explain how that works. Both the Financial Accounting Standards Board and the International Accounting Standards Board, who respectively come up with US GAAP and IFRS, state that the primary users of financial statements are an entity's existing and potential investors, lenders, and creditors. That's because the main objective of financial accounting is to report on a business's financial health to these external parties. That's not to say that other groups of people like management, regulators, and the public won't find financial statements useful. But keep it in mind that existing and potential investors, lenders, and creditors are the main reason why financial statements exist, to protect these external parties that are funding or potentially going to fund the business. In contrast to this, in managerial accounting, the target audience is all internal. The main objective here is to create internal reports to help the managers within the business plan for the future, make informed business decisions, and manage risks, which in turn will impact on performance and profitability. Okay, so now for difference number 2, outlook. When it comes down to it, financial accounting involves reporting on past transactions and events, whereas managerial accounting is more focused on the future. Financial accountants put together reports like the income statement and the balance sheet to summarize transactions that happened over a period of time, or the closing balances of assets, liabilities, and equity at a single point in time. In the past, this period of time or point in time that we're talking about is always in the past, and it's historical information that financial accountants rely on to build these financial statements. On the contrary, management accountants make reports to help management make decisions that impact the future, like budgets or forecasts which determine how a business chooses to allocate its resources. Next up, I'd like to talk about scope, because this is completely different for both of these accounting branches. In financial accounting, the scope is broad. Financial statements consolidate the results of all of the different departments and business units so that external parties can get an understanding of the big picture of the whole business. Meanwhile, in management accounting, the scope is much more narrow. Management accountants like to slice a company up into different segments, divisions, and cost centers to provide the managers of all of these different areas with detailed reports to help them specifically. These reports might not be limited to financial information either. They might contain non-financial information like detailed commentaries or explanations to help support the data by telling the story. And that leads me nicely into difference number 4, priority. In financial accounting, the focus is always on being objective and precise. Financial statements are meant to reflect a true and fair view of a business's state of affairs at the end of an accounting period. No guesstimates allowed here. But in managerial accounting, the priority is on being relevant and timely. What use is a super accurate report if it comes to a manager too late and isn't relevant anymore? For this reason, management accountants are given more leeway to use estimates and shortcuts if it means that they can deliver their analysis on time. Estimates and shortcuts? Sounds a bit dodgy, eh? Don't management accountants have some rules to follow? Not really, because their reports and analysis are confidential and for internal use only. Management accounting is less regulated than financial accounting. There's no framework to follow, so their reports can take on whatever format they like. However, financial accounting is heavily regulated. Remember when I talked about GAAP and IFRS earlier on? Well, these are the principles and standards that financial accountants have to adhere to. GAAP and IFRS lay out a strict roadmap that show us how we should record transactions and present that information in financial statements like the income statement, the balance sheet, and the statement of cash flows. And that's no wonder really, since the users of these statements are external. They need to be protected from fraud and misinformation. And on top of that, financial statements sometimes need to be audited. Audit is a completely different branch of accounting where a business hires an independent external group of accountants whose job it is to review and check over financial statements before they can be approved and sent out to the external lenders and investors. Now, at the start of this video, I promised you 5 differences, but as a little bonus to you, I've got one more. Difference number 6. Are they even necessary? Management of financial accountants. Who needs them? This one's nice and simple. Financial statements, and therefore financial accountants, become essential once a business grows above a certain threshold that's unique to your country, whilst management accountants are technically not required. You can think of them more as a luxury that companies don't necessarily need, although they can be extremely valuable when it comes to making decisions about strategy and the future. So which is better? That is a very hard question, and probably a silly one for me to have even brought up in the first place.
All right, so that was the difference between managerial accounting versus financial accounting. Just so you know, if you're worried, I have linked these YouTube links to the bottom of the slides already on the e-class as well. So I put those on the last slide for you. Okay, so what we're going to do is we're going to look at page 12, problem number 1. So if you look at your CAPTUS book, page 12, problem number 1. Okay, so we have here a bunch of different transactions A to G, and we're supposed to find out in terms of the functions of accounting, one of them is the first one, for example, scorekeeping, is it attention directing, or is it decision making? Now, do we remember what we talked about before about what scorekeeping was about when I brought up the analogy of the Raptors and the Lakers? What does scorekeeping do in accounting?
The financial part of it?
Sorry?
The financial part of it?
Yeah, so the financial, so you're recording transactions. We're trying to see what the score is, how are they doing? How is the business doing, right? And then the next one will be attention directing. And what are we looking for? Attention directing tells us what is that about?
It's like it focuses on like what is the goal. So like if you want to increase the sales by like 10%, and then it goes in like how to achieve it, like how to execute the plan, measure the results, like and then like see what the outcome was, like how to like reorganize your resources or see if it was successful. Okay, yeah, that sounds good, but it kind of sounds like it's interlapping with decision making. So what do you think the difference between attention directing is and decision making? You don't have to answer that. So what we'll do is we'll go through these questions and we'll be able to see what the difference is actually. All right. So for part A, paid rent for the month of January on its office premises, $25,000. Do you think that's scorekeeping, attention directing, or decision making? You can drop your thoughts in the chat. Scorekeeping. Yeah, so this is scorekeeping, all right? Issued invoices to its customers for goods delivered in January, $1,500,000. Which one is this? I'm seeing scorekeeping again, scorekeeping. All right, yeah, scorekeeping. C, calculated
how much cash came in during January and how much cash went out during January to evaluate its liquidity position. So we calculated these things in order to evaluate the liquidity position. Good, I'm seeing attention directing, and that's correct, right? So we want to focus our attention on the liquidity position of the business. In view of the liquidity position shown in C above, asked its bank to increase the line of credit by $20,000. What is that? Right? So now we can see the difference here between our attention directing and our decision making. Okay. Okay, next one. At a meeting of the managers, the chief financial officer told the other managers that although the company was adequately profitable, it had a liquidity issue. So what are we doing here? Although the company was profitable, it had a liquidity issue. Right? So yeah, I would say attention directing as well, because it's telling us that we have to focus on something, right? As a result of E above, the chief operating officer told all production units to reduce their inventory holdings by 10%. Reduce it by 10%. What did I just do? I made a decision, exactly, all right? So they told us what to focus our, well, first they gave us a score, then they told us what we need to focus our attention on, and then they give us a decision. This is what we're doing. And G, the company circulated its financial statements for the previous fiscal year to the shareholders. The company circulated its financial statement for the previous fiscal year to the shareholders. So what are we doing here? Yep. Scorekeeping, yeah. And you can also argue that you're also directing attention to different parts of the financial statements as well. That's right. Okay, good job. So are we comfortable with the difference between these? So questions like this, these are questions that you can see on your midterm number 1, okay? Questions like this can come up on your midterm number 1. Okay, chapter 2, this is the chapter now. IFRS the International Financial Reporting Standards. These standards were talked about in the last video that we watched, and he described it as the rules. It's like the rules that govern the financial accountants. This tells us all the standards that we need to abide by when we're doing our financial reporting. Okay. Elements of financial statements. Some of our friends mentioned this in the beginning when I asked, what is accounting? Talked about assets, liabilities, and equity. What are assets? Who can tell me what they think an asset is? What is an asset? An asset is what the company owns. Sorry, somebody asked me to go back. Can you give us a short brief of what attention directing is? So attention directing is where, for example, you will be given, let's just say you are given, somebody tells you that the sales for this month was $60,000, right? And they can tell you to focus on, we can focus on this because that sales of $60,000 was $10,000 less than we had predicted it to be. So now you're focused on, wait, we made $10,000 less in sales. Why was that? So now I'm focusing my attention on that, right? But then when your manager comes in and he says, this is what we're going to do in order to boost sales in the next term, then this is decision-making, because he now has, this is the plan, this is what we're going to do. Okay, so that question was for Lassetti. So if you understand it now, I hope so. Okay, great. Now back to the question of what are assets? Something useful to the company, an asset has value, what the company owns. So equity is just assets minus your liabilities. Okay, great. Yeah, so all of those are perfect, right? So an asset is something that the company owns. Asset is an economic resource controlled by the company as a result of past events. Some examples of assets will be bank account, money, cash, car, land, building, accounts receivable. Accounts receivable, write this down, you'll need it later on. Accounts receivable, this happens when you sell something, someone does not pay you, but they're gonna pay you later on. So that's accounts receivable, okay? That's an asset, right? They promise to pay you. Another thing you can see is prepaid rent. What does prepaid rent mean? Prepaid rent means that rent for this, for the month of February is $5,000. And I said, you know what, I'm gonna just pay for it now. I'm paying for my rent right now. So in January, I've already paid for February's rent. That prepayment of rent is an asset to me, okay? That is an asset to me. Liabilities, what is a liability? Okay, yeah, it's an obligation to pay, right? So we owe something. So OSAP loan is a liability, a bank loan, bank credit. Yeah, if you're owing money, for example, I'm gonna use the same rent one, right? I can pay my rent in advance. That's a prepayment of rent. That's an asset. But what if I owe rent, right? What if it's January and I didn't pay December's rent, right? So that's called a rent payable, which means that I'm owing it. I need to pay that. That's a liability for me, okay? Also, what if I bought something from someone like some supplies and I didn't pay them? Can consider that. That's called, the account is called accounts payable. So there are a bunch of different accounts that you're going to have to get acquainted with. And the good thing is there is a list of accounts that I'm going to post. I'll upload it to the e-class, a list of accounts that fall under assets, liabilities, and equity. What about equity? I explained that before. Anybody remembers what equity is? Company's value, assets minus liabilities. Yep, equity talks about what did the owner contribute to the business. So owner's contributions are considered to be equity. Yeah. Okay, and also if the business makes a profit, any kind of net income, profits less, sorry, your sales less your expenses, that profit is also going to be part of equity. It's going to be called it's called retained earnings. The profit that we decide to reinvest in our business is called retained earnings. It's okay if all of these terms are new to you, but you're going to have to get acquainted with them after this class. Revenues and expenses. Revenues are sales, right? Sales, simple. Revenues are sales. Whatever you sell, when you sell things, you make revenues. But guess what? This is the important part. Listen to this. If you sell something, whether you are paid or not, it is still a revenue. You don't have to wait until they gave you cash for it to be considered revenue. I'm selling this pencil. You come to my store, I give you the pencil. As soon as you have your pencil in your hands, I have made a sale. Now you can look in your purse and you say, oh shoot, I forgot my debit card. Can I pay you tomorrow? Yeah, no problem. Come back tomorrow and pay me. I still made a sale even though I was not paid today. So we're not waiting for cash to be exchanged. We're just waiting on me to give my end of the bargain. I gave you the good, I provided you the service, I have made revenues. Expenses is the same thing. What do you think expenses are? What are expenses? Costs, okay. Money spent on the organization, okay. All right. So expenses are the things that we need to incur, or the costs we incur in order to generate revenues. All right. We need to incur costs in order to generate revenues. In order for a business to function normally, we have to incur some costs, and those are called expenses. Okay. So here, if you can see, there's a small list of accounts here. So under assets, we see the cash, accounts receivable, buildings. There are some current assets, means that they're short-term assets, means that we expect to liquidate them into cash within 1 year. Long-term assets, that means that we expect to hold on to these assets for longer than a year, like a building or a vehicle, right? But for cash, for example, we expect that will be a current asset because that's going to be flowing in and out of the business on a regular basis. Then there's liabilities. Our liabilities are also made up of short-term liabilities, which we expect to repay within 1 year. But our long-term liabilities, we expect that we're going to be holding on to those liabilities for more than 1 year. And then equity, these are the accounts that can fall under equity, owner's equity, owner's withdrawals. So not only can the owners give the business money, but they can also take money out of the business, and that's called owner's withdrawals or drawings. Retained earnings, I talked about, and dividends. All of these different terms, you will be seeing them throughout this course, okay? Now, something that's very important here is the accounting equation. The accounting equation is assets is equal to liabilities plus equity. This is very important. So just in case anyone was falling asleep, now's the time when you have to wake up and rub your eyes. The accounting equation is assets is equal to liabilities plus equity, okay? Now let's look at this drawing here, this diagram. Equity, this part of the statement of the equation, what did we say equity was? It has to do with what the owners put into the business, correct? So the owners put this in, they put in money, but when they put the money in, what do we do with it? What do we do with the money that the owners invest into the business? Anyone can tell me what we do with the money that owners invest into the business? What does the business do with that money? We spend it on different costs, we buy goods, we invest in assets, we use the money to generate revenues, all right? So that's right. So the money that they give us, we are going to be generating revenues. And of course, in order to generate revenues, in order to make money, we have to spend money. So we're going to be incurring expenses. So the owners have contributed capital to our business. But then we also realize that from that money that they contributed, the profits, there are profits that we're going to have as a result of that, and that is going to be reinvested into the business as retained earnings. These two things here go into equity, okay? So capital contributions is going to make equity get bigger, right? Equity will go up the more that the owners put in. And the more retained earnings we have, the more retained earnings we have, the bigger equity will be, all right? So when you look at retained earnings is whenever we have revenues less expenses, we're going to create profits, right? If we have revenues and we take away expenses, we're gonna have profits. That's going to make retained earnings increase. Retained earnings get bigger the more profits we make. But what makes our retained earnings go down? Our retained earnings can get smaller when owners keep withdrawing money. So if we pay dividends or if they just take out their own drawings, okay? So let's start from the beginning. Revenues less expenses gives us a profit. This profit makes retained earnings grow. If the owner withdraws money, then this makes retained earnings get smaller. And retained earnings makes equity grow Capital contributions makes equity grow. So what do you think expenses is going to do to equity? Expenses will make equity do what? Get bigger or smaller? Two people said something. One said smaller, one said decrease. Does that mean that everyone else, 51 people, don't understand what I just said? Should I repeat myself? All right, now, okay, thank you. Now I'm seeing, okay, people are here. All right. So expenses will make our equity get smaller. It will make it decrease. What will revenues do? The more sales we make, what will that do to equity? Equity will go up, exactly, right? Good. So you understand this? Do you understand this part right here? Yes. That's really good. If you understand this part right here, you're almost there. We're almost there if you understand that.
Sorry, Professor, could I just ask a question?
Yes.
What ACC mean? Like, is that profit?
Accumulated profits, yeah.
Okay.
So
thank you.
accumulated profits mean that the profits are just like a total profit.
Okay.
You deserve more. More flavor.
That the business owes.
All right, so we're gonna listen to this a video about the accounting equation. Oshini, go ahead.
Sorry, that was my other question. Sorry.
Okay, so basically he's gonna repeat what I said, but in a different way, and hopefully the people who didn't get it the first time will get it the second time.
Below. So, why the accounting equation? This equation lies at the heart of accounting and is the foundation of the double entry accounting system. I hope you find it informative. Let's do this. The key principle behind the accounting equation is that stuff the business owns is equal to the stuff that the business owes. And it is vitally important that you remember that this equation balances always, always, always. Now let's say I come up with this amazing idea for a business. I want to make popcorn and sell it. I've got $5 in my pocket and I decide to lend it to the business. Now there is a word to describe the stuff that the business owns, and that is called assets. On the other side of the accounting equation, we actually have two different words to describe what the business owes, and that depends on who the lender is. We use liabilities to describe what the business owes to third parties, and we use equity to describe what the business owes to its owner, in this case, me. So assets equal liabilities plus equity. There we have it, the full accounting equation. Simple, hey? So that $5 that my popcorn business now has is called an asset. And that $5 that my business owes back to me is called equity. See, it balances. Assets can include things like cash, accounts receivable, inventory, plant, property and equipment, land and buildings, investments and goodwill. Whereas liabilities can be made up of accounts payable, loans payable, wages payable and taxes payable, amongst other things. The most common forms of equity are stockholders or owner's equity and retained earnings. I will cover retained earnings in detail in a further video, but for now you can just think of it as profit held for future use. Now let's add some totals to the above and see if this thing still balances. Of course it does. The accounting equation always balances. And a balance sheet is basically a snapshot of our different assets, liabilities and equity at a single point in time. A balance sheet is one of the most important financial statements. There is a lot you can tell about a business by looking at its balance sheet. Right, so at the beginning of this video, I promised you a couple of examples, so here we go. If I head down to the shop and spend $5 on corn, then I no longer have $5 in cash, but I now have $5 of inventory. The categories have now changed, but my total assets stay the same. My balance sheet is in balance. Now I need to pop this corn, but I don't have enough money to go and buy a pot. So I go to one of my friends and I ask them if I can borrow $10. The business's cash increases by $10 and loans payable go up by $10 as well. Total assets are now $15 and my liabilities plus my equity are now also $15. We're still in balance. I then go and spend this $10 on a pot. My cash goes down by $10 and my equipment goes up by $10. Let's say I go and sell this first batch of popcorn at a 60% markup on cost. So I've made sales of $8. All my inventory has now gone. However, I now have $8 in cash and have made a small profit of $3. My profit is $3 because my sales were $8 and my corn cost me $5 to buy. 8 less 5 is $3. Remember I said that we can think of retained earnings as profit held for future use. So my retained earnings are going to increase by $3. Because my business has made a profit of $3, my total assets have now increased from $15 to $18. So to recap, in this video, we have learned that stuff that the business has is equal to the stuff that the business owes. This can be reworded to form the accounting equation, assets equal liabilities plus equity. This equation always balances. The expanded accounting equation forms the balance sheet, and a balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. Whew. If you have made it this far, thank you for watching. As I said at the start of the video, I'm making a playlist on accounting basics, so soon.
Okay, so that really explained the accounting equation again. So we'll have practice on it though coming up very, very soon, okay? I just wanted to bring these three concepts to your attention. An investor, we all should know what an investor is. Many of us are right now investing in Bitcoins and stocks and all these different things. Someone who invests in the business by contributing capital or equity, buying shares, etc. A creditor this time, the business owes the owners or other lending institutions. And a debtor, people owe our business. So for creditors, we owe, and for debtors, they owe us, okay? Just keep those definitions in mind. Let's go to problem 2, page 12. Problem 2, page 12. Actually, I think I wanna hold off on this. Let's see, problem 2, if it's an investor credit, yeah, I'm gonna hold off on that because I want us to be able to go through the examples of the accounting equation before people get too tired. I know that it's a bit late. Okay, perfect. So the accounting equation. Can you go to, no, don't go, never mind, don't go. Never mind, don't go to anything. Let's stay here. Okay. In your textbook, chapter 2, there are some transactions on page 22. I'm gonna ask you not to look at the answers on those pages. Just for anyone who knew exactly where to go, I want you to focus on the screen for now, okay? So the first transaction said the owner invested $25,000 in the company. The owner invested $25,000 into the company. If the owner invests $25,000, what does the business get? The business gets $25,000 in, somebody says $25,000 in assets. What, be more specific, which asset is that? Which account? Cash, correct, Joseph, correct. So cash is going to go up by $25,000. So increase in cash. Now, as I said before, remember this diagram. What else increases if the owner invests money into the company? Somebody says capital contributions, and capital contributions is going to do what? Not retained earnings, no, that's different. Retained earnings is when we have to reinvest profit into the business. Exactly, increase equity. Very good, Joseph and Oshini. So once we invest $25,000 into the company, we are going to get cash. So cash will increase, as well as equity is going to increase. So I'm gonna call this capital contributions. And so we know that this is equity, and we know that this one is going to affect our assets. Now think of it this way, if we have $25,000 under assets and $25,000 under owner's equity, does our equation balance? Our equation just does balance, it does. So I'm gonna pull up this. So transaction number 1, At the beginning, it's all $0. So after transaction 1, we have $25,000 in assets, and we have $25,000 in owner's equity. What do we have for liabilities? Anything? Oh, sorry, I will fix the sharing. Thanks for letting me know. Share screen, share the whole desktop. Let's just do that. Better? Perfect. Okay, so $25,000 there. What do we have for liabilities? Liabilities is 0. Good. Thank you. And then for the next one here, it says the company borrowed $10,000 from a bank. The company borrowed $10,000 from the bank. If the company borrows $10,000 from the bank, what accounts can you think about? What accounts?
Liability.
Liabilities is part of the equation, but give me an exact account, right? We borrow from the bank.
Cash.
So somebody says cash, and that's correct. If we borrow $10,000, we're going to get cash, okay? So cash is going to increase. What else is something else going to increase? A bank loan, correct, bank loan, not accounts payable. That's different. All right, so let's call it a bank loan. So assets are going to increase by $10,000, correct? Because asset is cash. What I'm gonna do, I'm gonna bring down this. And then we're gonna increase that by $10,000. Oh, is it owner's equity that goes up, or is it liabilities? Which one? The bank loan, is that owner's equity or liabilities? Liabilities. Okay, so finally, we have an amount. Let's add this up to see how much do we have for assets right now. 35,000 for assets. How much is there for liabilities? Well, saying the 10,000, and then we're gonna hit them with 25,000 for the owner's equity. So good so far. The company uses $8,000 of its cash to buy inventory. The company uses $8,000 of its cash to buy inventory. What's gonna happen to, what accounts can you think of that's affected there? What accounts? Be specific. Cash. Very good, Joseph. So cash is going to go down by $8,000. That's right. So what I'm gonna do is I wanna put the originals back. Let's put the originals back. And then you're saying that cash is going to go down by $8,000. All right. But what else happens? Inventory. What happened? Somebody says inventory, $8,000 in. Okay, okay. So what we just saw there is a transfer of assets, right? So everything happened on the asset side. Nothing happened over here. We reduced our cash by $8,000, and then we increased our inventory by $8,000. So does anything change on the asset side? No, assets remain the same. So it's safe for me just to copy and paste this again, right? So nothing has changed. It's exactly the same. Number 4 says the company purchases an additional $5,000 worth of inventory on, somebody says, Will, I'm gonna stop because somebody asked a question, I love questions. Will owner's equity not increase? Can you tell me why you think owner's equity should increase? Inventory. All right, okay, let's go back over here. Let's go back. Inventory is an asset account. Owner's equity deals with these things here, right? These in this top left. Do you see anything here that has to do anything with inventory? No, right. So inventory is an asset account. Inventory is going to always affect your asset side of the equation because inventory is an asset, okay? But if it's any of these revenues, expenses, withdrawals, accumulated profits, retained earnings, capital contributions, these are the things that are going to affect your equity, okay? So if you want to figure out, does it affect equity? Refer to this diagram right here and it will let you know. Okay. So let's go back here now. Are we good with this one? We're good with that one. Okay, good. Number 4, the company purchases an additional $5,000 worth of inventory. The company purchases an additional $5,000 worth of inventory. What's going to happen here? What accounts are affected if we purchase more inventory? Oh, you know what I just like? I saw that someone says everything stays the same. Now, can somebody tell me why everything does not stay the same? Why doesn't, what somebody else says, assets does not change. Now I'm gonna go ahead and start it for you. The company purchases an additional $5,000 worth of inventory on account. On account means on credit, okay? Only if they purchased it with cash that you'll have inventory going up, cash going down by the same amount, so nothing happens. But this time they purchased it on account, means that they didn't pay cash, they actually owe something. So inventory goes up, but something else, liabilities also goes up. Thank you, Steve, that's right. So inventory is gonna go up by $5,000, right? And then liabilities is also gonna go up by $5,000. How do we feel about that? Jacqueline says, I got it now. That's good. I like that. Okay. So now we have new figures here for our assets is now 40,000, liabilities is now 15,000, and our equity remains the same. Yes, if something is bought on account, liabilities is always going to increase. That's correct. Yes, on account means on credit, something we owe. Perfect. That's correct. That's exactly what that means. Now, if you can see this whole time, our equation keeps on balancing, right? 40,000, what we own is equal to 40,000, 15 plus 25, what we owe. Always equal, right? If you look up all of these, they're all going to be equal. And if it's not equal, you guess what? You did something wrong. So I'm going to copy and paste this down, bring down the beginning balance. Okay, let me paste the special, just the values, please. All right. So, oops. Okay, goods sold for cash, $7,000. Purchase price was $4,000. Now, what do you think we're gonna do here? We sold goods for cash, $7,000. Assets decreased 4,000 and increased 7,000. Okay, this is what wait, everyone stop for a second. Let's stop saying assets decrease, liabilities decrease. We're gonna get confused. Be specific. What accounts are being affected? Tell me the account first, and then we'll decide if that account is an asset or if it's a liability or if it's owner's equity. Which account is being affected first? Cash and inventory. All right, so somebody says cash is gonna increase by $7,000. Let's do that transaction first. Let's do that transaction first. Cash is going to increase by $7,000. Okay, so let's do that one first. So if we sold something, what do we get? We get cash. Well, sometimes we don't get cash, right? Sometimes they owe us. But what is that called when we sell? Sales, another word for that will be revenues. Perfect, thank you. So revenues. So we know that we received cash of $7,000. So that means assets will go up 7,000. Whenever we receive, oh, somebody said accounts receivable. No, accounts receivable is if they did not pay us. Then instead of it being cash, it's gonna be called accounts receivable, also an asset. But let's go back to this. $7,000 is going to go up. Assets will go up $7,000. But what is how do we balance it now? Right now, it's $47,000 here. And this is 15. And this is 25,000. It doesn't balance.
So like, I suppose there will be owner's equity will be profitable by 3,000 because like there's a difference between 7,000 and 4,000. Like there's a 3,000 difference.
You are correct. You are correct. Yeah. But this is what I want to do. I wanted to break up this into two easy parts. So I'm going to highlight this for you right here. You see this part right here? You see that right there? Yeah. Goods sold for cash 7,000. I want that only. Forget about the 4,000 right now. Only that I want. $7,000 goes up in cash for assets, but it needs to go somewhere else. Where am I going to put the 7,000s with balances? What happens? Increase owner's equity. Exactly. Yeah. Somebody said liabilities. No, it's not liabilities. It's equity, because look at our diagram here. Equity, revenues makes equity go up. Expenses makes equity go down. So if we have revenues here, we made 7,000 revenues, then that means our equity is also going to go up or down. Our equity is also going to go up. So now do we balance? Up, 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 up. Very good. Lots of ups. Good. Now we balance, right? 47, 47, we're good. But now that we're finished recognizing a sale, and remember that, friend, you know what? Stop. Write this down. When you sell something, write what I say down, type it or whatever. When you sell something, you have to record the sale. To record the sale, you are going to increase equity. Always increase equity. Then you have to decide, do I increase cash or do I increase accounts receivable? If the customer paid in cash, I will increase cash under assets. If the customer did not pay me as yet, I will increase accounts receivable under assets. All right, that's how you record a sale. It's not like a credit card, but you can think of it that way if that makes it easier for you. It's just a promise to pay. They're gonna pay you, not right now. Credit card, you get your money, right? If someone comes in and they buy something with you and they pay with your credit card, You get the money. You just owe the bank now, right? So it's different. So now that we're finished recording the sale, we remember in order for us to make a sale, we're gonna have to spend money. We're gonna have to have an expense. You can't just make revenues like out of the blue. You have to spend to make money. So what did we spend to make that $7,000? What did we spend? We spent $4,000, that's correct. We spent $4,000. So what's gonna happen to that $4,000 in inventory that we sold? Where is it gonna go? Do we have it still? Do we still have that 4,000 in inventory? Yeah, it goes out of equity, that's right. Because it's called cost of goods sold, write that down. This thing here, this expense we're taking out of equity is called cost of goods sold. Now what happens to our assets? Do we still have $4,000 in inventory?
Nope.
No, it goes away, right? Our inventory goes down, and remember, inventory is an asset, so it's going to go down. Why did we reduce owner's equity? Good question. So we sold $7,000. Okay, we sold $7,000 of our product. Okay, $7,000 was the price that they paid us for our product. But obviously, we're not gonna sell our product for what we bought it for, right? If you're selling laptops and you bought the laptop for $800, when you sell it over to someone else, aren't you gonna try to make a profit on that? So the cost of your inventory is probably $800, but when you sold it, you said you want to make a profit, you're gonna sell it for $1,000, right? So when you have sold $1,000, you get $1,000 in cash, and your equity goes up because you've made a sale, that's revenues. But then you realize in order for me to make that sale, I had to spend money on inventory. And that inventory, the cost of it was $4,000, they're saying in this example. Or in my example, the cost of your laptop was $800. So you're going to reduce inventory by $800 because now you no longer have that one laptop in your inventory. And because you had to because you had to pay or spend money in order to make money, that's your expense there. So the expense is the cost of goods you sold. And the cost of goods you sold was the $4,000. So it's gonna make equity go down. Expenses brings equity down. Revenues brings equity up. Expenses brings equity down. Whenever you sell something, you make revenues, but you also incur an expense. We just hope that our revenue is more than the expense. Does that make sense? 2 yeses? That means that everybody else doesn't know what's going on? Yes, yes?
Yeah.
All right, we're good, okay? That's good. So I'm gonna tell you, this is probably the hardest part of the class today. The hardest part of the class today is understanding this. And it's called, you can write this down, revenue recognition, expense recognition, or matching principle. And you'll see that in this chapter as well. The theory part of it. This is just the practical practice part. So how do we recognize revenues? And how do we recognize our expenses? And how do we make sure that we match the revenues that we earn to the expenses that we had to incur in that period? That's what we're doing here. So the red part here gives me the revenue, and the green part here is gonna tell me, I'm gonna put that as green. This part is telling us about the expense, the revenue. Goods sold on credit, $9,000. The purchase price was $6,000. So look at this now, goods sold on credit. So again, I'm gonna highlight this part in red. This is the goods, this is the sale. Okay. Purchase price was $6,000. Yes, credit is like on account, exactly. You didn't, they didn't pay you in cash. They did not pay you in cash. No, they did not. But that doesn't stop us from recognizing the sale. Okay, so who can help us first with the red part? Red. How do we recognize a sale? It's exactly the same way I did above there, okay? Just know that there is one difference. How do we recognize the red part, the sale? Assets go up. Yes, correct. What else goes up when we sell something? Owner's equity goes
Equity.
up. Yes, correct. When we sell something, also owner's equity. Correct. Good job. This is the red part. Red. And now, I want to ask you a question. What was the asset that went up? Was it, if it wasn't cash, then what was it then? What was the asset called? Accounts receivable. That's correct. Good. Now, who wants to tell me how we're going to recognize the expense, the green part? What do we do?
So like in owner's equity, we're gonna minus 6,000 and there will be a profit of 3,000.
So 6,000 goes down, right?
Yeah.
For owner's equity. And what else goes? Somebody says assets decreased by 6,000. Can anybody tell me why assets is going down now? What's causing the assets to go down?
Because yeah, inventory is at loss.
Inventory goes down. That's right. Inventory goes down. And why does the equity go down again? Because it is an expense. Exactly. Good. Perfect. Good job, friends. All right. Customers who bought goods in question 6 has settled the full amount. Part 6. So people bought on credit, but now they said, listen, they paid us. See, told you they were going to pay us. They paid us now. So they paid us now. So what do we do? Accounts receivable becomes cash. I like that. Accounts receivable becomes cash. Good. Exactly. Somebody says cash is going to go up now, and then accounts receivable is going to go down because we no longer owe, they no longer owe us, right? So that means assets doesn't change. Very, very good. So I'm going to put both of those in there. So what happens is that that amount that they owed us was 9,000. So accounts receivable is going to go down, right? Because now we don't owe that 9,000 in red anymore. They don't owe it to us anymore, sorry. But cash is going to go up because they gave us cash now. So it's like we transformed the accounts receivable into cash, and that really stresses the idea of a short-term asset. You see how easy and how quickly these things change, right? Short-term, within 1 year, it's gonna change or become cash. 9,000 there, so does anything change here? No, everything remains the same. So I can just copy and paste that down there then. All right. Are we good with that? Everybody understands that?
Yes.
Yes, 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 yes. 2 yeses. Okay. Yes, thank you. You are welcome. All right, good. Settle the liability incurred in question 4. In transaction 4, there was a liability. We purchased some inventory on account. We didn't pay them. Oops. sorry, we didn't want to pay yet, but we're gonna pay you now. So what's gonna happen to
Liability will be minus by 5,000 and owners, wait, so we are paying the cash, so liability will be
how do I
minus.
keep doing that? It's like I forget how to use a MacBook. Okay, let's try that again. Copy, paste. All right, perfect. So somebody said liabilities is going to do what?
Will decrease by 5,000.
Okay, so we no longer owe people, right? So now let's, okay, so we're gonna reduce liabilities. That's good. We don't owe you anymore. So we have less liabilities. Thank you very much. Okay. And now what else happens? Because we are paying them, so
Owner's equity also go down.
so if we pay out cash, it affects our owner's equity.
Yeah.
Okay, let's go back to the diagram again. I like when this happens. The more we see this diagram, the better for us, okay? Okay, look at this, right? Look at this. This diagram here, do you see anything on here that has to do anything with the word cash? In this diagram at the top here, anything
No.
says cash? No. So because cash is an asset account, it's only going to be affecting the asset side of the accounting equation. Only the variables in that diagram, that's what you're going to be looking at for equity. Okay. So if we're paying out cash, which type of account is cash? Cash is a asset, liability, or equity account?
Asset.
Asset. So that's going to mean that cash is going to cause what to go where? We're paying them back, so our cash is going to go
Decrease by 5,000.
by 5,000, which means our assets are also, well, cash is an asset. So that means our assets are going to go down by 5,000. Okay. So good, so good so far. Okay, good. So then we copy and paste this, bring it down here. All right, so this one says payment of the bank loan interest, $100. We paid the bank loan interest. Interest, if we pay the bank loan interest, what do you think is gonna happen? First of all, think about the accounts that are there. Which accounts can you see in that one?
So like cash will decrease by 100 and our liability by 100.
Okay, so somebody said, somebody said cash will decrease by 100, but somebody mentioned the word expense. Is interest, the interest on a loan, is that a liability or is that an expense?
Liability.
Liability, 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 no. Interest is an expense, interest expense. Okay, you gotta write that down. I can see how you can confuse interest because it has bank loan interest, but the interest is the expense. All right. So we're gonna pay it, so we know for sure. This is one is easy that cash is gonna go down. That means our assets go down. But then assets, interest is an expense, so that means what else is gonna go down? Expenses affects what? Equity. Very good. So equity is also going to go down. Still balanced, right? We're doing good. We're balanced still. That's good. That's good. So the last one says declaration and payment of dividend, $1,000. So we declared it and we paid it. What's going to happen here? If we pay the dividend out, what's going to be affected? What accounts can you think of? Somebody says assets will decrease by 1,000 because it's cash, right? because we're paying it out. So yeah, I can see that. I can buy that. $1,000 is gonna go down for assets. And then a dividend, just like interest, is an expense. Exactly. So the expense causes which part of the accounting equation to move? The owner's equity, correct? So the owner's equity is going to go up or down?
Down.
Down. Very good. Okay. So again, we are balanced, right? So that was pretty much what you're going to need to really know for some of the text, well, a lot of the technical parts of your next midterm, of midterm number 1. As long as you understand this, you're already doing really, really well. So practicing after our lecture today would really, really help you to do even better at this course. All right. Do we have questions so far? And remember here, I said to you that up here, I showed you this, and we saw that withdrawals is an expense, causes the equity to go down. Well, a withdrawal was what happened in that last one there, where we declared and paid a dividend. That will count as a withdrawal. All right, it reduces our owner's equity.
I have a question about that owner's equity. Like when you sell something, like it comes out of the owner's equity. Is like owner's equity like an umbrella term for equity? Or
sorry, can you repeat one more time?
yeah, sorry, I was just confused because like I remember like in the part where it says like when the goods are sold for cash for 7K, the purchase price was like a 4,000. Like I was wondering, why does it come out of like why does
the $4,000?
Yes.
Why does the $4,000 come out of owner's equity?
Oh, because it's a inventory, right? So like
yeah. Okay, yeah.
Because like I thought owner's equity was just like whatever the owner invested. So like
that's one side of it.
Okay. Mm-hmm. Oh, right. Okay.
That's one side. What did the owner invest is one side, and then the other side has to do with our profits. So revenues minus expenses gives you profits, and then your profits and goes into your retained earnings. So the more profits you make, the more accumulated profits you have, the more retained earnings you have. But then what's going to happen is that withdrawals tends to reduce your retained earnings, which then feeds into what we have as equity. Now, revenues and expenses are here. Expenses reduces your profits.
Right. Okay.
Right? Profits, if you have less profits, it's going to affect your retained earnings. It's going to affect negatively your equity as well. So what happened here is that when you sell something, you have to consider that there was a cost that you paid to sell that good. It's called cost of goods sold. The cost that you paid to sell your goods for $7,000 was the $4,000. That's the cost of the goods that you sold, $4,000. And that is the expense.
Okay, makes sense. Thank you.
You're welcome. So we're all good here. This table just shows you different words, capital contributions, different words that they refer to these under the different types of businesses. For example, for withdrawals, drawings is called what they call under sole proprietorships, partner drawings under partnerships, and dividends on the corporations. All right, so that's just for your general knowledge. Okay. I think I want us to take a break now because this is, yeah, we need to take a break. All right, so can you take a quick 10-minute break, and then we will come back and we'll have maybe it's gonna take another, I think maybe another 40 minutes, okay? So we will be back at 9:10.
Sorry, quick question. Are
Yeah.
most of the classes, would they mostly end at 10 o'clock or would they usually end a little bit earlier?
No, usually the classes will end right at 10 o'clock. For example, next week we have 3 chapters that we need to cover. So I just want everybody to get it, get themselves in that frame of mind that this is just going to be a very, it's going to be a packed class every single week.
Okay, thank you.
You're welcome. All right, so welcome back, everyone. Let's see if we can finish this last part up as soon as possible. So in chapter 2, they also introduce us to the financial statements. Not to worry, because there is a chapter for each of these statements coming up in the next couple of weeks. So income statement, I think we're going to work on that next week, and the week after that we'll be working on, actually we work on the income statement and balance sheet next week. Please mute your microphone. Please. Thank you. So we will be working on these things later on. This is just a brief introduction. So the income statement is telling us revenues less expenses. How profitable is our business? How did we perform in the past? Revenues, we learned what that is. Expenses, we know what that is. Revenues less our expenses gives us our profit, sometimes called net income. If you notice here, we see that sales revenues less our operating expenses gives us our operating income. And then if you look down at the bottom, we have net income. Now, what do you think from what you see is the difference between an operating and a net income? Net income is the final income you make after you make your deductions for income, taxes, and interest, okay? So operating income less our interest expense, less our income taxes, gives us our net income. Okay, good. Then we have a statement of retained earnings. We have also talked about retained earnings in this class already. And we understood that if a company is profitable, then it has a choice to make. If I make a profit up here, right, we made a $65,000 profit. We have a choice now as a business. Now we can say, well, we have $65,000 of profit. We can reinvest this full $65,000 back into the business so that we can continue to operate and continue to grow as a business. Or we can decide, should we pay out some of our profits to our shareholders or to the owners, okay? Should the owners withdraw some money in forms of drawings, or should we pay out dividends to our shareholders? So that's what the retained earnings statement shows us. It shows us what we're really and truly doing with our accumulated profits. What have we decided to do with it? Any questions on the retained earnings statement? Pretty straightforward. Any questions on the, anybody confused about the statement of retained earnings? No, we're all good, all right. Couldn't copy down the equation on the previous slide. You really don't have to copy it down. This one, you don't have to copy it down. It'll be in your textbook. This is taken from your textbook.
Yes, thank you.
All right, okay. So then we have a statement of retained earnings. It looks like this. It starts with the retained earnings that, so the beginning retained earnings that we had. And then if in this new year now we make a profit, our net income, we add it to the retained earnings from before, which gives us a total amount. And then we deduct the dividends that will give us the retained earnings at the end of the current year. So basically what happens is the retained earnings from last year gets brought into our new year in the beginning. Let's just say at the end of December 2021, we made a total of $50,000 in net income, and we decided we're going to reinvest all of it. So that comes over into January 1 as a beginning retained earnings amount. And in January of 2022, at the end, we realized we made a net income of $10,000. We're going to add that to the ending retained earnings from 2021. We're adding that together to get a total amount, and then we can deduct from that any dividends that we may have paid out in that year to give us our retained earnings at the end of that year. And that retained earnings is going to be moved on into another year as the beginning retained earnings of the next year. Then the next one we have is the balance sheet, and that just shows you a snapshot of the company. It shows your assets is equal to your liabilities plus equity. It just shows you your accounting equation. And we learned accounting equation. Most of the people in this class have already, at this point, almost mastered the accounting equation. And so your balance sheet is just showing you a snapshot of the accounting equation. So if we see here, we have a current assets, long-term assets is equal to our total assets. I've already explained the difference between the current and long-term assets. And then we have our current liabilities. Long-term liabilities gives you total liabilities, plus equity is going to give us total liabilities and equity. And you see, this is the accounting equation. Assets is equal to liabilities plus equity. Right there. That's what the balance sheet does. So then the next one is a statement of cash flows. And I think this is the last statement that you do in this course, the statement of cash flows. It just shows you how are we doing for cash. We're looking at cash coming in to the business, and we're looking at the cash going out. What is the change in the cash balance from the beginning of the year to the end of the year? How was our cash being used? Where did our cash come from? These are all the questions that a cash flow statement can answer for us. Again, when we get to that week, we'll be working on this, but this is just a quick introduction. And then we'll also see as we go along the course that the financial statements are all interconnected. Okay, so we'll talk about that more when the time comes. I wanted us to quickly go to page 14 in our CAPTAS textbook, and we're going to be looking at problem 6. Page 14, problem 6. And it's right here. So page 14, problem 6. What it does here is they give us hold on, let me try and pull this down a little bit so we can see it. So right here, we can see that they give us prepared a budget at the start of the year, which shows a profit that we expect to receive of $100,000. Actual results showed a profit of $250,000. This is the actual results down here. We get $250,000, but you are given the budget and actual results below. What did we budget to make in profit? We budgeted that we will make, as in we predicted that we should make a profit of $100,000. And we actually made a profit of $250,000. So the question is saying, comment on the year's results. Okay, should management attention, this is one of our functions, attention, right? Attention directing. Should management's attention be drawn to any particular aspect of the company performance? So let's look at the different variables. For example, the first one, let's look at sales revenue. Budgeted, we expected that we should have $750,000 in sales, but actually we had $900,000. How can we comment on that? What can we say? We can say we did well, we did better than expected, there's more sales, very good. So we can say that, that's right. So sales increased, we have more sales than we planned. And what about expenses? How are we looking for our expenses? Let's look at the cost of goods sold, the purchase for goods of goods for resale. $250,000 was the budget, and we actually ended up spending $300,000. So we spent more. Is that a bad thing or a good thing? It's a good thing. Why do you think it's a good thing?
So because you have to spend money in order to make money, it like kind of balances out, like because you did, and like even though you spent like 50,000 more than you expected, you ended up making so much more.
Exactly, right? That's very good. Very good. If they had to if they actually had to spend a lot more on purchases and it just wasn't worth it, the increase in revenues that they have, then maybe we'll have a problem at that point. And then our other expenses here are rent, wages, utilities, other expenses of $350,000 is what we actually ended up spending, but we budgeted to spend $400,000, lower than expected. Very good, Joseph. Very good. So then we can say that our profit here budgeted as of $100,000 and then actual results, $250,000. So this is us we are directing our attention to these different variables that they have produced through scorekeeping, right? We are directing our attention to that. And so now somebody can say, let's go and let's work on the decision-making function. We can actually make a decision now to see what are our next steps? How can we continue on in the future? All right. Again, the solutions for everything that we've looked at today should be on your e-class as well. Okay. Okay. So question segment. Any questions? Any questions? Any burning questions? Everybody just is okay and ready to go to bed? Remember, you can't go to bed yet, though. You gotta stay up a little bit later after I leave and go through this stuff all over again. All right. So optional self-study activity. This is what you're gonna focus on. Oh, perfect. And it's perfect timing. Natasha says, what is our homework for today? This is it right here. Okay, so you're gonna go over the self-study activity that we did. That's with you remember that Excel spreadsheet I was going through with what happens to assets, what happens to liabilities, equity, you remember that? So you're gonna go through that again by yourself. Make sure you understand all of those different transactions. Try to see if you can build your own balance sheet and income statement, all right? What I'm gonna do after this class, and I'll write it down, is I will post a template. Let me show you what the template looks like because I already have one. I just didn't put it on the e-class. I'm gonna post this template for you here. So what you can do is you can just plug in your numbers. So you plug in your sales revenue, these numbers in, and you can create your own balance sheet, your own income statement. Plug in the numbers here, you can complete your balance sheet. And if there's any information, you can also create a retained earnings statement by plugging in your numbers into this template. All right, very quick and easy. All right, so this is the final part of our class. Final part. This part talks about the characteristics of useful accounting information. All right, stay with me. You can do this, don't worry. Use the characteristics of useful accounting information. So as I said here, these concepts are heavily tested on your midterm number 1. Heavily tested, write that down, all right? Heavily tested on your midterm number 1, you need to know the characteristics of useful accounting information. Now I've included them here. There's a few slides of them. We talk about accounting information needs to be relevant. Right? It needs to have predictive value and it has to have confirmatory value. There's also examples for each one of these. Accounting information needs to be material. What does that mean? It should be faithfully represented. What does that mean? And examples to go with it. Accounting information has to have, it must be comparable or consistent, verifiable, timely. Understandable, you must be able to understand the information as well. Okay. And then we talk about going concern, economic business entity. We talk about a monetary unit, periodicity, historical cost, revenue recognition, which we talked about before. When do we recognize revenues? It does not matter when we receive cash. Matching principle, which talks about also the expense recognition as well. It does not matter when we pay the cash. And we'll talk about that more in the coming weeks. But this information here in these last few slides are very important for you, but I'm not gonna go through them with you. just because it's just theory and you just need to read them and read the examples and understand. But what I am going to do before I dismiss you is that we're going to listen to this this video that I found here. And they just go into just explaining some of these concepts as well. And then this will be it for the rest of the night.
Shake it like that, shake it boom.
Hello, how are you?
Grammarly does more than catch errors. With Grammarly, you can
carryover. What's up, everyone? Welcome back. Patrick here, and in this video what I'm going to go over is the qualitative characteristics of financial information. And it may actually be a couple of videos depending on how long these explanations are going to be. I'm guessing it'll probably be multiple videos, multiple parts. So quick little review from the previous videos. We had this flow chart here for a financial accounting system. So we have an entity, financial data. That financial data gets put through a financial accounting system or through a specific set of rules. We mentioned it's called GAAP, Generally Accepted Accounting Principles. And then you're going to get financial information, more specifically, financial statements. And I mentioned the 4 different financial statements we're going to be looking at in this course: balance sheet, income statement, cash flow statement, and statement of retained earnings. And so what we're going to be doing in this video is going a little bit more deep into this part here, into the financial information. And more specifically, the question that we're going to answer is, what qualities should this financial information have in order for it to be useful for these external users? And there's actually 6 qualities that we're going to go through. And so the first quality is relevance. Second quality, faithful representation. Third quality, the financial information has to be comparable. Fourth, verifiable. Fifth, timely. And then sixth, it has to be understandable. And so what's going to be happening is that I'm going to go into more detail for each of these 6 qualities and explain what they mean. And there's going to be definitions sometimes within them. So yeah, these set of videos may take a little bit of time, but highly important. It's a really big chance that you're going to be tested on this stuff on your midterm and on your exam. Now, a couple of things I want to mention before we get into detail on each of these. Notice that I group these in a certain way. So I put like 1 and 2 here, and then 3, 4, 5, 6. That wasn't by accident. A lot of times you'll see textbooks grouping these qualities. And so these first 2 are usually called the fundamental qualities. Now, not all textbooks, not all profs are going to group these. Sometimes they'll just list all 6, but a lot of textbooks will group them. So these 2 are called the fundamental qualities. So they're pretty much the most important. And then these 4 here, they're called the enhancing qualities. So these are the fundamental, kind of the foundational qualities, and then these 4 enhance these, right? So that's the first thing I want to mention. Second thing I want to mention is that these 6 qualities here are based on the 2010 standards. So before 2010, this list was actually different. It was a list created in 1989, and then what happened was some time passed, and then in 2010 they decided to update the list. So this is based on the 2010 standards, and what I think is going to happen is they're going to further update this list at some point, in my opinion. Because what you're going to find when I'm explaining these is that there's going to be a lot of carryover. There's going to be stuff that I mention maybe in relevance, and then I'm going to mention almost the same stuff in timely. And you're going to think to yourself, wait, didn't he mention that in relevance? And unfortunately, it's something that you're going to have to deal with. It's something I got to deal with as well when I'm trying to explain this to you as best as possible. So you may run into scenarios in your course where there's going to be multiple qualities that are violated. But as long as you can explain them, then you should be fine about why they are violated. And I think once I go into specifics on each one, you're going to get a better understanding of how to explain it. So yeah, it's just something you're going to have to deal with. There may be some carryover, and it's why it's my opinion that this list is probably going to get updated so that there is less carryover, a little less confusion about which quality is actually being violated. But anyway, that's just my 2 cents. But the more scenarios you go through, the more questions that you do regarding these qualities, the better you'll get at recognizing which qualities are followed or which qualities are.
All right, so as I said, all these different principles, you're going to have to go through them on your own with the examples that are at the bottom. These slides are also already uploaded on your eClass as well. And also, I would also suggest looking at Taslima's, Taslima also posted her lecture from last semester. She would have gone through this a lot too. All right, so those are all of the different resources that you can use to access more information on those different principles, right? So for tonight, when you finish, or for tomorrow morning, or at some point tomorrow, go over the questions that we did again today. Try to go over all of those principles at the end that we didn't get a chance to really cover. And then also see if you can try to build your own income statement, balance sheet, and statement of retained earnings if you can. All right. There's also the solutions for the questions that we were taking up today should also be on your eClass. You can go over those as well. And then this week you should, next week you should have a tutorial with, the tutorial's name is David McIntosh, and he's really, really good. He's just as good as explaining things as me, if not even better. You can also go to his tutorial because he will be taking up more questions that I did not take up in class next week as well. All right, so have a great night. We were actually able to finish a bit early today, so thank you for coming.
Thank you.
You're welcome. Thank you. Bye.
Have a good night.
Have a good night. Thank you.